Any trading business that deals with a high volume of stock items should periodically perform a physical stock take in order to detect stock loss or indeed stock gain. And it's important to note that a stock loss is detected by comparing the physical stock take figure to the balance in the stock card. And remember, stock cards are maintained in a perpetual recording system. And by detecting the stock loss, the business is ensuring they are complying with the reliability QC by generating reports that are free from bias or error. So in terms of reasons for stock loss, there could be theft. That's probably the most common one. There could be a oversupply to a customer, and that needs to be specified. So for instance, let's say a customer orders 100 and due to a counting error is issued 102 units and it's recorded as 100, then the stock take will basically identify stock loss of 2 later on. It could be an undersupply from a supplier, so same type of scenario here. Let's say the business orders 50, they're only actually physically given 48, but it's counted as 50 and recorded as 50. Again, that will result in a stock loss. Damages and breakages not recorded. I used to work in a liquor shop where occasionally bottles would fall on the floor and we were required to actually give the caps to the inventory person who would record that loss. Now, occasionally some would literally be swept under the carpet. There could be a stock take recording error because some items were literally out of mind, out of sight, not recorded. In terms of reasons for stock gains, well, it could be an oversupply from a supplier. So again, let's say we order 50, we're given 52, we record it as 50 due to accounting error. That will result in a stock gain. Or we could also have an undersupply to a customer. So let's go through a practical example. According to this firm's stock records, they have 16 units on hand and the stock take reveals only 12. So that's a loss of 4 units. So in order to work out the value of the stock recorded in the out column for the stock card, we use the first in, first out rule. And the oldest existing stock on hand is, of course, the $80 units as listed first in the balance column. Thus, we record this in the out column of the stock card and make sure in your details that you actually use the source document, which will be a memo. Identify the memo number so that we're supporting the audit trail. So in the general journal first, we debit the stock loss account and credit the stock control account for $320. If a narration is required, and if you do a narration on the exam, it's most likely that it will be on a stock question because there is more detail required. Make sure, of course, you identify the source document number so we support the audit trail. You'll need to identify the number of units lost for, in this case, a brief description in terms of stock loss, and identify the actual type of stock line. In terms of the general ledger entry, you'll need to do a reduction in the asset account, stock control, so therefore we do a credit entry. And an expense has been created here because we've got an outflow of an economic benefit in the form of a decrease in our assets, stock, and a simultaneous decrease in owner's equity. So therefore we're satisfying the criteria for an expense. So therefore a debit entry to the stock loss account is required. So let's deal with a stock gain. Stock records show 6 units on hand. The stock take reveals 8 units on hand. So we've got a gain of 2 units here. Now the Conservatism Principle states that we record the gain based on the lowest value on hand. We only have one value on hand in this case, $85 per unit. So thus a entry is required to the in column of the stock card. Likewise, a debit in the general journal and the general ledger for the stock control account, and a credit to the revenue account stock gain.